But one of the things that's so appealing about Opendoor as an investment is because it is category dominating. I think in the future, in the 2030s and beyond, the majority of home sale transactions will be done by corporations. This is a really big topic, with a lot that can be said.
Hi, Tyler. Thank you for taking the time. Can you start talking a little bit more about Opendoor, what it is and what's the difference between Opendoor and a traditional realtor?
Yeah, for sure. Thanks for having me. So my name's Tyler Okland, and yes, we're talking about Opendoor today. So Opendoor is a relatively new prop tech company, and it's an iBuyer, which means that they are basically getting in the middle of the home transaction process in residential real estate. And so Opendoor's first product, which is Sell with Opendoor, is basically a product where homeowners can sell their home to Opendoor with a few taps of a button, a virtual showing, basically an entirely digital process. And so if you're familiar with the traditional process of buying and selling your home, it's a pretty stark departure from that traditional experience. And since Opendoor launched in 2014, they've really focused on that core offering of Sell with Opendoor, but they've also expanded into buy-side products and ancillary services as well.
What do you think makes Opendoor special? What's the size of the market and how big can the market be?
Yeah, I think there's a lot of things that's special about the company. I think the fact that there are not many companies in their space sort of suggests that it's a really interesting and challenging problem. It's not just software, but it's also not just operations, right? It's not just people going from home to home and managing properties. It's a combination of the two. So it's the atoms and bits aspect of it that makes it really unique. And so that's why I think a lot of people have compared Opendoor to Amazon, for example, because Amazon is logistically a really heavy company. Operationally, you have to be excellent to run a company like Amazon, but then there's also the software component as well. And bringing those two together is really unique for a technology company.
What's the potential of Opendoor? Opendoor valuation around right now is around $4 billion, right? How big can Opendoor be? You compare to Amazon, so that might be a good comparison to make, but yeah.
Yeah, so when you think about the size of the market that Opendoor is going after, it's a multi-trillion-dollar industry every year, right? And so the size of the market is actually bigger than the size of many markets that are currently dominated by big tech companies. And so there's a lot of things that have to go right for Opendoor to get to that size. But one of the things that's so appealing about Opendoor as an investment is because it is category dominating the residential real estate industry, which is multi-trillion-dollar potential. And so if Opendoor can scale into that opportunity, it will be a mega tech company.
So what percentage of the market does Opendoor operate right now?
Yeah, so in Q1 of this year, Opendoor was responsible for 1 out of every 130 sales transactions in the United States. So a little under 1%. Over the past few months, that number has come down a little bit as sales have been more challenging with the recent drawdown in home price valuations, kind of a slow summer as a result of mortgage rates peaking and then also just some other macro circumstances. But I would say, 1 out of 130 sales was their peak, right? So after 8 years of operating as a company, 0.76% of all home sales was Opendoor's peak. And they're currently, I guess, 5 times bigger than the next closest competitor. So it just gives you an idea that it's very early in the opportunity for these iBuyers.
And so is the potential for Opendoor to be, 50 times bigger? Can it get to 50% of the market? Like how big can it get 10 years from now, let's say?
Yeah, I think this is sort of a contrarian take, but I think in the future, in the 2030s and beyond, the majority of home sale transactions will be done by corporations, by technology companies. I think technology companies will facilitate the majority of home sales in the United States. And that doesn't mean that Opendoor is going to have 50% of home sale transactions. I actually don't think that that's really their aspiration. or at least not to be the principal in 50%, because you can imagine the capital required to hold that many homes at a given time would be really challenging. I do think there's an opportunity for Opendoor to be responsible as the principal for something like 10 to 20% of transactions. And then they also manage another 10 to 20% of transactions or something like that on their third-party marketplace. So homes owned by individual consumers who want to list their homes on the Opendoor platform. And so when you're asking about how big Opendoor can get, that's really the how big can they get on a percent of transactions perspective. But if you're talking about an investment, it's very different, right? Because the unit economics just improve from here as they gain advantages from scale economies, and their fixed costs are spread out across more transactions. They have higher margin services like the third-party marketplace, mortgage, title and escrow, homeowners insurance, home warranty, and moving. So the opportunity is more of a geometric one when it comes to an investment from here if things work out.
Cool. Can you describe a little bit more about, what's the experience of the average consumer with Opendoor, and like how does Opendoor make money in the process? So you mentioned, the high margin services, so title and escrow, and some other, third-party services, the third-party marketplace. Can you describe a little bit more about the process between consumers and Opendoor and how it makes money in each transaction?
Yeah, so in a basic home sale transaction, a consumer can download the Opendoor app and say, type in their address, say this is my home, and Opendoor will use its automated valuation model and some information that you complete in the application to send you a range of values that they would offer you for the home. And for that liquidity premium, right? That making things easier so that, you don't actually have to talk to anyone. You can sell that home with a tap of a button from your couch. No negotiations, no staging, no cleaning. Opendoor will charge a 5% fee. And so you make 95% of whatever the offer is that they send you, but you can close that offer within the week. And so, the process goes, after you get that offer, they will either send someone out to inspect the property, or they'll just do a virtual inspection. So you can kind of take your camera around your house and show all the different rooms and everything. And that's the end of the data collection. And then if you agree, you can check out really there and then with the money in your bank account. So that's selling, right? But then there's also home buying. And there's a lot of different avenues that consumers can buy a home with or from Opendoor. I think on the buy side, there's a lot more opportunities to attach services like title and escrow, mortgage, homeowners insurance, home warranty, like we talked about. But those would really just be add-on services that as a consumer could be a better experience, because you don't have to go searching for all these different services, right? You don't have to pay the customer acquisition costs for all these different services. They're all done in one app with Opendoor. And Opendoor currently just has mortgage and title and escrow as their ancillary services, and they don't really have a third-party marketplace yet, but those are long-term divisions of the company.
Sounds good. So is Opendoor a little bit similar to, what's the name, Carvana? And a question attached to that, why did Zillow enter the business and fail in the business while Opendoor continues to do well? Can Opendoor survive given all the interest rate hikes, that the Fed is doing?
Yeah, so I think in response to your first question, Opendoor is pretty similar to Carvana in that, it's taking an expensive, antiquated industry and finding a way to be a middleman in that industry. And so it's really like displacing whoever the salesperson is that's usually taking a commission of your vehicle or your home in the situation. And so I think the biggest difference is that cars are much more of a homogeneous asset class than homes. And so there's a lot more data science and valuation importance when it comes to buying a home. And so Opendoor's data science team is probably has to have a smaller variance, definitely has to have a smaller variance in their accuracy as compared to a Carvana, but they're both considered iBuyers. In response to your second question about, why did Zillow enter the space? I think this all goes back to the market dynamics of owning unique supply. And so this is very similar to Airbnb, right? But if we take Opendoor, as Opendoor continues to scale, and it's going from 1 in every 130 transactions to 1 out of every, say, 30 transactions, right? It's going to be owning at some point over 100,000 American homes at a given time. And so that's a ton of very important, unique inventory. And so as a result, what follows unique supply? Demand, right? Demand follows unique supply. And so if Opendoor has all this unique supply, they're going to get more and more eyeballs on that supply, more and more demand that follows. And so the next logical thing to do, if you're strategic and you're building that company, is to create your own listing system, right? Who needs the the MLS if you can just list all the homes on your platform where you already have all this demand from consumers, but then also residential real estate investment trusts, institutions like BlackRock and Blackstone, where all these people can come and see all this unique supply that Opendoor has. And I think Zillow, in particular, Rich Barton, their CEO, when he began to see the scale and how well that Opendoor's value proposition was vibing with the consumer, they realized that they were going to be displaced as the marketplace if they didn't enter into the space.
And why did Zillow exit the iBusiness market? And why is Opendoor gonna be able to succeed, even though Zillow, has an amazing CEO and they weren't able to make it profitable?
Yeah. So just to clarify, you're asking why did Zillow exit and why will Opendoor be able to remain profitable?
Succeed. Yeah. Yeah, exactly.
Remain or survive. Profitable. Yeah. So
exactly.
So in Q3 of 2021, what happened is that home prices started to decline. And there's 4 iBuyers in the space at this time. There's Opendoor, OfferPad, Redfin, and Zillow. And the 2 largest were Opendoor and Zillow. And they were getting not head to head, but Zillow was scaling pretty rapidly. And as prices started to decline, Opendoor and OfferPad began to back away on purchases. They began offering less for homes, widening their spreads, selling off inventory, right? Like trying to manage inventory responsibly. And Zillow, on the other hand, just kept buying homes at higher and higher prices. And so, as home prices were going down, Zillow kept buying at higher and higher prices. And they got to the point where they were buying all this inventory that was worth a lot less than what they purchased it for. And, they began looking at the inventory write-downs they were going to have to take. And they realized that, despite being in the space for 3 years, that they couldn't price homes as accurately as they wanted to, or they could, but they didn't have, the managerial discipline to commit to those data. And so as a result, they exited the space. They sold off a bunch of inventory. They lost close to $1 billion in write-downs, and they're nearly out of the iBuying space. I think, when you talk about the differences between Opendoor and Zillow, because right now Opendoor is going through a not dissimilar situation. That the magnitude is very different, but it's a similar situation where home prices deteriorated faster than really they ever have, as long as I've studied residential real estate. And Opendoor, unfortunately, was buying homes at a material clip right up until homes started to depreciate. And so currently what we're seeing is that Opendoor is going to be holding a lot of inventory on their books that is worth less than they paid for it. This is very different than Zillow, right? Opendoor is still going to have positive contribution profit margins and positive gross margins, but it's not the agility that you want to see in the space. That said, it's hard to imagine an event like this happening again, as it hasn't happened before. But it just kind of shows you that home prices aren't really meant to move quickly, and so you have to be pretty agile to respond to the speed that that home prices came down in the past few months.
Can you describe a little bit more about what's happening in the market, what the central bank's doing, and why that's affecting the home prices, and how that compares, to the 2008 crisis, and how that affects Opendoor, and can Opendoor survive?
Yeah,
Sorry.
This is a really big topic, with a lot that can be said. I'll start off by saying that 2008 and today are very, very different situations, and no crisis, no downturn is exactly the same, but I just think it's important to say that they're completely different, number one. But what we've seen over the past few months is that the Fed raised rates rapidly to combat inflation, and mortgage rates tend to follow interest rate rises. And mortgage rates hit 6%. And it was a huge shock to the market, even though there was a very small amount of home inventory in the market. And I think, Opendoor, myself, most people sort of thought that the small amount of supply would be able to overcome a shock in demand as a consequence of mortgage rates going up. But just the speed and the amplitude of mortgage rates sort of crashing through that ceiling really brought home sales and home prices to a standstill. And so, the biggest difference between today and 2008 is in 2008, there was tons of inventory, right? There was way too much inventory in the market. And so when you had diminished demand, you also had too much supply. So one thing fed after another. Today, we still have a very small amount of inventory in the market, which, makes for a softer landing potentially. But I think the shock of the Fed raising rates and mortgage rates hitting what they did was so much that the market couldn't really tolerate it. And we saw, a 5+% drop in home prices in a very short period of time.
And how does that affect Opendoor? Can Opendoor survive the interest rate hikes? The Fed will continue to hike apparently this year, and maybe continue to hike next year. So that might affect, mortgage rates and even the median price that the buyer is willing to pay for each home.
Yeah, so I'll say the issue isn't so much the absolute hike as it is the speed of the hike, and so what I mean by that is that Opendoor is going to be able to survive higher mortgage rates because we're still at multi-decade low mortgage rates today. Even though it seems really crazy because the past few years we've had 2 to 3% mortgage rates, but you go back 20 years, or you talk to someone who bought a home in the 90s or 80s, and they're like, oh, my mortgage rate was in the teens. So American home buyers have sort of had a wide swath of different mortgage rates, and people still buy houses. It is going to be more difficult now because home prices have come up a lot and wages haven't followed, but people are still going to have to move. And so I think Opendoor will be fine there. In regards to interest rates, Opendoor does have to handle interest rates, and they're charged interest rates on the homes that they own because most of their inventory is funded with debt. But that said, you have to think about this from the financial perspective. Opendoor turns that inventory 3 to 4 times per year. And so let's say we raise interest rates by, let's say 10%, right? Let's say that Opendoor has to deal with 10% increase in interest rates, right? You divide that 10% by the number of turns that they can do throughout the year. So you say, okay, Opendoor is going to turn that debt 4 times throughout the year. They're going to sell $250,000 homes 4 times that year. So that means that every time they sell a home, they're only going to see a 250 basis point hit from interest fees. And so how are they going to pay for that, right? Because it's a low margin business. They would just be offering the consumer 250 basis points less for the home because, they have to hit their own margin targets, and they're supposed to be agnostic of what the interest rates are. And so that's how their business model is built. Every time the Fed raises interest rates by 1%, they lower their offers to consumers by however many turns of inventory they're going to have that year. So it'd be like 33 basis points.
That makes sense. So a question related to that is, you mentioned an example of how you can basically add that cost of the rate hikes to the consumer. Can you explain a little bit on how Opendoor is dealing with the hikes right now? So what's going on with Phoenix, and how can that reverberate into other markets?
Yeah, so Phoenix is Opendoor's oldest market. It's historically also one of their largest markets as well. And Phoenix was hit particularly hard with price declines this summer. And so as a result, Opendoor, who owns thousands of Phoenix homes, is seeing quite low margins in that area on those inventory. I don't think it's necessarily a Phoenix specific problem. I think Phoenix was just fast and the earliest, and Opendoor holds the most homes there, so it's the most obvious. But I do think that most markets are pretty weak right now in the United States relative to where they were in the middle of the summer.
And so does that affect Opendoor revenue growth? So, Opendoor, I think last quarter, not this quarter, was year over year. Its growth was around 1,200%, and now it's 200%. Is that revenue slowdown going to continue, or is it just a bump in the road because of the speed of rate hikes? What's going to happen to Opendoor revenue growth in the next few years? What would you expect it to happen?
Yeah. I mean, first thing I'd say is it's kind of crazy to say that like Opendoor is slowing down, going from 1,200% to 250%. But also they were scaling from basically zero, right? So they had basically no inventory at the conclusion of 2020. And so they were really scaling throughout 2021. And so that's why we had these artificially inflated, crazy, like 1,000+% revenue growth numbers. I'll say that despite all that, their first half of 2022 already has more revenue than Opendoor guided for in their original investor presentation for the entirety of 2023. So it just kind of shows you that the company is executing pretty well, right? Like they're doing pretty well as a company. They're far outstripping their original guidance and bench posts that they set for themselves. All that said, the long-winded answer to your question is yes, revenue growth is going to slow over the next two quarters because one, homes didn't really sell at the end of the summer as a consequence of all the macro things that we discussed. But two, they're really going to have to find the balance between sell-through and margin because it's pretty easy to fire sale your inventory. What's hard is to do that with prudent unit economics. And so Opendoor is going to have to figure out which inventory did they really buy poorly. And it's going to take far too long for them to, wait for the homes to appreciate to a point that it makes sense to sell. And which homes can they hold out a little bit longer on a price that makes sense so that they can maintain their contribution profit margin targets.
On that note, Opendoor made a deal with Zillow this quarter. Can you describe a little bit more about what's the deal with Zillow and what it can signify to Opendoor growth? Is it important right now or is it important in the future? And why is it important?
Yeah, I think it's important for a lot of reasons. Perhaps most importantly, because it means that Zillow expects that Opendoor is here to stay. It's like if you can't beat them, join them sort of situation, right?
And what's the deal? Sorry, what's the deal? Can you describe a little bit more about the deal before we? Yeah.
What? I'm sorry. What?
Sorry. What's the deal? Like, what's the deal that Opendoor made with Zillow? Can you describe a little bit more about the deal?
So the deal is basically that Opendoor and Zillow, are going to become partners with Opendoor's Sell with Opendoor product. And so consumers that are using the Zillow website are going to be able to get offers from Opendoor if they want to. And then, Zillow will give those consumers a Zillow agent or representative to guide them through the process and be able to attach products to that.
Mm-hmm. And why is it important to Opendoor?
Yeah, it's important because it brings more eyeballs to Opendoor's top of funnel, right? So Opendoor gets access to all of Zillow's eyeballs for buying homes, and potentially it could make it so that Opendoor can be more selective about the homes it purchases because it's got a wider number of homes that it can select from.
And does that mean that Opendoor will accelerate growth, or like what does it mean to Opendoor's growth and margins and everything else?
Yeah, I don't know if it necessarily means that Opendoor is going to accelerate growth because it's not on the sales side. So it doesn't improve Opendoor's sales velocity. It just improves their purchase velocity. I think if it's going to do anything, it's going to improve Opendoor's margins because, as I said, Opendoor will be more selective about the homes that it purchases, and so it could potentially have better margins on the buy side.
That makes sense. And so it seems that Opendoor's net income was negative this last quarter. They had positive earnings. Will they continue to have negative net income? And do you have a guess of what's going to happen, in the next few quarters?
Opendoor will have negative net income for the next 2 quarters. They'll post net loss.
And why is that?
Because of all the macro stuff that we were talking about. So, it's a really challenging time for them. They have a lot of inventory that is worth less than they thought it was going to be. And so they're going to have to sell off at lower margins than they anticipated. So definitely net loss for the next 2 quarters.
Cool. And can you describe a little bit more about Opendoor Exclusives and what it is and what it means to the business?
Yeah, so Opendoor Exclusives is a buy-side initiative that the company has been internally working on since September of last year. The premise is that it's a private marketplace that Opendoor operates with its own inventory. And so if you're a consumer in the markets that Opendoor Exclusives has launched, you can go on the Opendoor Exclusive site, browse for a home, and have a checkout experience to buy that home. So it's a completely digital solution. So there's no real estate professionals involved at all. You basically log in, see a home you love, virtually tour it or tour it on your own time. And then if you love it, you can click a button and reserve it for an hour while you fill out the paperwork. If you sign the contract, you reserve it for 2 days while you sort of go through everything with the company. It's a really interesting product for that reason. But then there's also additional features like Opendoor Exclusives homes are listed for 2% less than they're going to be listed when they come off the Exclusives website. And so that's another consumer advantage as well.
So can you talk a little bit more about Datadoor and what it is?
So Datadoor is is our data analytics startup that I started with Sebastian Schutero. So him and I both created Datadoor, and what we do right now is we do data analytics for Opendoor and other prop tech companies. And so the idea there is that we've been tracking and analyzing Opendoor transaction data on a granular level since January of this year, but we sort of launched a commercial product just a few months ago now. We have both a retail investor offering as well as an institutional investor offering. And we basically use those data to inform estimates for quarterly results for the company.
And what's Datadoor Atoms?
Yeah, Datadoor Atoms is our retail investor product offering. And so it's a subscription service. You get access to a dashboard of Opendoor sales and margin data, Opendoor Exclusives, market by market granular data, and then also our estimates for the quarter and monthly reports once a month.
Sounds good. Can you talk a little bit more about, you mentioned that you think that institutional investors will buy or be a big percentage of home buying. You mentioned as well Blackstone and BlackRock. Will they be big participants, and why?
Yeah, I think if you study business strategy over the past 100 years, that's really just the way that things have gone, right? We're moving further and further away from artisan one-off salesman situations to a completely commoditized experience, right? So it's a completely digital process end to end, as opposed to all these all these middlemen involved who are taking their own cut of the transaction. And the reason for that is because like basic business economics, if you are a corporation involved in a fragmented, multiple counterparty process, you can charge less than they all do combined and make more than each of them individually does. And so that means that business and consumer win. And so I think what we see in the car buying industry with Carvana and the other car iBuyers, that's really a herald of things to come. And these companies still have to figure out their business model and also how to be profitable. But it's the same thing we saw on Amazon, right? Like it used to be that if you wanted to buy something, you'd go to a department store or to a mom and pop retail store. And now, a significant proportion of our commerce is done through Amazon, Shopify, these other sites. The same thing is going to happen to buying and selling a house. It doesn't have to be as expensive as it is. And it certainly doesn't have to be as a malignant a process as it currently is. And so that's what these companies are really setting out to do is to dominate that space, but also do it in a way that consumers can have a delightful experience, but also not have to pay a bunch of fees to 8 different counterparties.
Oh, that makes sense. Yeah, that was great. Yeah.
Oh, cool.
Other questions related to Opendoor, but yeah, that was super interesting.